What's up, everybody? This is our third installment of Sippin Tea with Kabani. Alrighty, just get myself a little organized here. I made some notes for everybody. I wanted to touch on today, basically, it could help first-time home buyers, and it can also just give you a little bit of an idea of how the home buying process actually works. I kind of broke this up into two parts, I would say. I broke it up into kind of like mortgage qualifications, and I broke it up into how the real estate agent can help. But realistically, I've really focused more on the mortgage part of it because I think that's really important for you to kind of start to wrap your mind around what is going to be required for you to be able to get into the market, or even help you know what numbers you kind of need to achieve in order to move up, and also what the cost associated with this could be. So it is Sunday. It is Sippin Tea with Kabani today. I got a little bit of just green tea, decaffeinated green tea. I'm going to give it a break this week for the fancy stuff because we're going to the basics with what we need to know in order to buy real estate. So we're keeping it basic with some green tea here today. So let's get started. So some of the stuff I wanted to go over is that what can you actually really afford to buy? And it really depends on what your down payment is going to be. Depending on what your down payment is, if you have something like less than 20% down payment, you are going to need to go through CMHC or Genworth as a mortgage insurer to have insurance on the mortgage. And we are going to touch on that in more detail. But if you're putting less than 20% down, you would look at your gross income that you have, so before taxes. And a rule of thumb kind of would be is that you would take your gross income and times that by four and a half times. So, so it basically, the thing is that it would be whatever your income is. If it is, $100,000, then it would be like 4.5 times that is what you can kind of afford. So if your household income is $100,000, you pretty much qualify for something around $450 in terms of having a mortgage. If you have more than 20% down payment, you would be looking at getting somewhere between like 5.5 to 6%, or 5.5 to 6 times what your gross income is. So if you have $100,000 household income, you could probably qualify for somewhere around $550,000 or $600,000. It could potentially be more as well, depending on if there's a rental income involved. Now, there have been cases where we've actually helped people buy real estate that are probably still going to be living with their parents. So what they have done is that they have used their income that they are getting right now, and plus what they've said is, okay, this condo is going to put bring in $2,000 or $2,200, and that's been added in to help them qualify for that property. So another way of doing something like that is that if you're buying a home that has, say, a basement apartment and you're going to be renting that in, you can actually try to qualify for a little bit higher based on accounting for that rental income coming in. So there is a chance if you're putting 20% down that you can qualify for more than the 5.5 times or 6 times your gross income. Obviously, there's going to be some catches. There are some lenders that will want to work with that and not work with that. It's really best if you are going to go this route, and usually I suggest this anyway, is to try to touch base with the mortgage broker first. Usually mortgage brokers have access to more lenders and different types of programs that would probably better suit your needs. Sometimes what happens is that, and I love dealing with TD, but I just use them as an example. If you go to TD, maybe their rental income qualification program is a lot more different than Scotia. Typically, I think it's been Scotia that's been a little bit more lenient on rental properties. So if you went through a mortgage broker, they would kind of know a lot more of where to place your file just to help you get better qualified for something like this. The next thing I wanted to kind of touch on was the actual CMHC insurance. So the CMHC insurance part of it is something, if you're, like I said, if you're putting less than 20% down payment, you are going to need to get an insured mortgage. So an insured mortgage, the premium actually ranges between how much you're actually going to put down on the property. So the ranges are something like this, and I wrote them down for you guys because I don't really know them off by heart. But if you're putting somewhere between 5% and 9.99% down payment, you're going to be around a 4% premium. If you're putting 10% to 14.99%, you're going to be somewhere between a 3.1% premium. And if you're putting 15 to 19.99% down, you're going to be somewhere between a 2.8% premium. And so that premium is calculated on the mortgage amount that you are going to be taking. Again, so that premium, what happens to that premium is that it gets calculated on the mortgage amount and it gets added to your actual mortgage. So if you're going to be taking on a mortgage of, $400,000 and your mortgage premium is $10,000, they're going to actually add that into your premium. I think the number actually worked out to being something like on a $500,000 mortgage, if you're putting 5% down payment, that's $25,000, and your mortgage premium would actually be $19,000. So just keep that in mind. $500,000 property, you're putting 5% down payment, that's $25,000 down, but guess what? $19,000 of that is actually gonna go to mortgage premium. So you only really have $6,000 into the property. Something to keep in mind. So the mortgage premium itself can be added into the mortgage, but there's also going to be a 8% PST tax. So provincial sales tax is still applicable to the insurance premium. So if you have a $10,000 insurance on the property, then you're going to have to pay $800 upfront for that premium. So that gets added into your closing costs at the end of it all. But so just to keep in mind, premium of the insurance gets added to your mortgage, and then the PST, the provincial sales tax, the 8%, you got to pay that upfront on closing. The other thing I wanted to kind of go over with you guys is that if you are going to go into an insured mortgage or a high ratio mortgage, they call it, there are some rules that CMHC actually has with this as well. So the property purchase has to be less than $1 million. And the other thing also is that the minimum down payment is still going to be 5%. Now, the 5% is only up until $500,000. So if you're going to be buying a property, say for $600,000, you would be able to put down 5% on the first $500,000. So that would be $25,000 on the first 500, and then you'd have to put down 10% on the balance of it. So if we're $600,000, that would be $100,000. That's $10,000 there. So for a $600,000 property, you would be putting down about $35,000. So that's your 5% up to $500,000 and 10% on the $100,000. The other thing also is that there are things when you go to qualify for a mortgage, the lender looks at and the insurer will look at. So the first one is a gross debt service ratio. So gross debt service ratio is something that encompasses all of your expenses that you are going to experience on your property. So the principal that you're going to pay, the interest that you're going to pay, it takes into account heating costs, it takes into account property tax, and it takes into account, if it's going to be a condo property, 50% of what the condo fees are. So if you're going to go through this insured mortgage like a CMHC, they probably have a little bit more of a tighter gross debt service ratio that they want you to meet. And I'm just checking, and I believe that was 32%. So if you are going to be putting down more than 20% and you're outside of this CMHC insurance, then there are some lenders out there that may accept a little bit higher. So that will allow you to qualify a bit higher. So 32% is with CMHC. That's the max it could be of your gross income. So if you have an income of, say, household income of $100,000, this is an easier number for me to calculate for you guys. So only $32,000 of that can actually be allocated to your housing costs. Okay. The other ratio that they look at also is your total debt service ratio. So this includes everything. So that's the gross debt service ratio. So that's all your housing costs plus any other debts that you may have. So if you have a car payment, if you have a line of credit that you're making payments on, if you have credit card debt, consumer debt, anything else that you're paying monthly on is going to be accounted for your total debt service ratio. And that they want to have at, I believe it was around like 38%, 38 to 40%. So if you exceed that, they're not going to qualify you on the mortgage itself. Now, that was about the insured mortgages. Again, now going back to something that you're going to put 20% or more down on. So when you put 20% down, it's going to actually help you qualify for a little bit more of a property, primarily because you don't have to get an insured mortgage. So now, if you make that household income of $100,000, you could probably qualify for somewhere around 5.5, like 5.5 to 6 times what your gross annual income is. So that would be something like, you make $100,000, you could probably qualify if you're putting 20% down for a mortgage of about $550,000 to $600,000. Again, now, just to remind you guys, that actually does change if you're going to have some type of rental income coming in as well. So if you have a rental income coming in from a basement, that's going to actually help you qualify for a little bit of a higher amount. And again, say for example, you are a first-time home buyer, you're comfortable staying with your parents, they're not charging a lot of rent, and you want to keep your expenses down, but you do want to get into the market and you have that 20%. We did this recently with another client of mine where he is going to be staying with his parents, and they did buy, he did buy a rental property, and he used his income that he was earning, plus he was able to use the income that he was already receiving from a tenant that was in the unit already, and that actually helped him qualify for the property. So there are different ways of going about this. And again, my huge suggestion to anyone that is going to be going through this process is look for a good mortgage broker. If you guys need some contacts for that, reach out to me. I'll be happy to help you, give you some contacts for that. But I think a mortgage broker would be the right way to go about trying to figure out what the best way to approach the application for a mortgage would be. The other thing I wanted to touch on was amortization, okay? And amortization, I think, sometimes gets confused between the term of a mortgage. So the way that the mortgage could work is you could have a 1-year term, 3-year term, 5-year term, 4-year term, whatever. So I think you can even have like a 10-year term on a mortgage, but that doesn't mean that your mortgage is going to be paid off in that amount of time. So typically people go for like a 3 or 5-year term with a mortgage. And what that basically means is that that lender is going to be providing you those funds for that set period of time. Likely, if you keep up your payments and everything, they're going to renew. But at that same time, when that 3 or 5-year term comes up, you can easily go and shop around for a different lender that may give you a better rate, more incentives, whatever the case may be. But that is the term. Amortization is different. So amortization, when we talk about that is the total period of time where it is going to take you to pay off this property. So now if you're buying this $500,000 property and you're going to put 5% or less than 20% down payment, they make you stick to a 25-year amortization. So what that means is that they take that $500,000, they factor in the interest that you're going to be paying on that, and they come up with like basically a monthly payment of how long it's going to take you to pay off that property, considering again the principal and the interest rate, and they extend it out to 25 years. So that would be your amortization. Now, with uninsured mortgage, so if you're putting 20% or more down payment, you can actually get a 30-year amortization. So they take that $500,000 property purchase and they spread it over 30 years. So that actually helps you with the qualification because your cost on a monthly basis actually comes down. So that does affect your gross service ratio, your gross debt service ratio. So you can actually qualify for more if you can extend the amount of amortization. I think back in the day, they still had like a 35 and maybe even a 40-year amortization. Sometimes we see this change as the market starts to tighten up. When financial regulators start to see like some risk in the market, this is some point where they want to start tightening up how long they're going to amortize properties until. And also, like I mentioned in my last video, is that CMHC, there is some rumbling, some talks about CMHC even getting rid of the 5% in general. And the talks coordinated with that is that if they do get rid of the 5% down payment to enter the market, they might actually extend the amortization from 25 to 30 years. This is all rumors right now, so nothing is concrete about this, but this is kind of generally how the amortization works on these properties. I say after you kind of understand roughly what you're going to be able to qualify for. So the information that I provided you is a little bit of Cole's notes on stuff that you could do on your own. Like you could look at what your income is and you can kind of calculate, if you have less than 5% to put down, then you're going to calculate your gross income and say, hey, 4.5 times my gross income is what I can qualify for. What does that mean? So you can kind of look around in the market and see if that's going to work for you. The best approach I would still say is that a mortgage broker is not really going to charge you anything to come up with these numbers. So maybe what you want to do is to get a little bit more detailed education about this is approach a mortgage broker. Tell them, if this is me, I would tell them, hey, I don't want you to run my credit report, okay? Because I don't want you guys to get dinged on your credit. So a good mortgage broker should be able to take your numbers that you have, look at the debts that you're servicing right now, and come up with a reasonable range of what you could possibly afford. So you could likely do that without having your credit ran. So I'll leave it with that for now with the mortgages. Like I said, if you guys have any, if you guys want to get in touch with some good mortgage brokers, give me a shout, send me a PM, and I'll get you guys in touch with them. The next part of all of this I wanted to touch on is the realtor part of it, a realtor interaction. So once you kind of figure out, that would be the first step, is first you figure out where you kind of stand in your mortgage and your financials and whatnot. The next part you want to do is get a realtor. My notes tell me, don't worry about that, just call me, I'm going to take care of it for you guys. But obviously, there's different people that work in different areas, and you got to obviously find somebody that you feel comfortable working with. I don't think it's a bad idea to interview a couple of agents until you have a comfort level with some. And I've gone through that with some of my clients as well. I've been interviewed either on the selling side or the buyer side. Maybe they've gone with me, maybe they've gone with somebody else. People that have gone with me usually have stayed with me. There are clients that I have done, I think now, up to like maybe 10 or 11 properties for that family alone. So you have to really have a good feeling about the realtor that you're working with as well. Make sure they're knowledgeable, especially in the areas that you want to kind of trade in. When we're talking about realtors, there are two kind of relationships I would say that you can have with the realtor when you're going out and purchasing real estate. One of them is going to be a buyer representation agreement, and one is going to be a customer service agreement. So there are like a key difference between this buyer representation and the customer service representation or customer service agreement. So when you have a buyer representation agreement referred to as a BRA, that means that you become a client of that brokerage, and that brokerage owes you fiduciary duty. So that basically means that they have to put your interest above anyone else's interest. So they are representing you in this transaction. Your interest comes before their own interest. Anyone else's interest, your interest comes first. They have to represent you to your interest. Now, versus a customer service agreement, they still have to be honest. They have to, operate with integrity. They have to be fair with you, but they don't really have to put your interest above anyone else's interest. They can put their interest above your interest and whatnot. The other difference between a customer or like a buyer representation agreement and a customer service agreement is that with the buyer representation agreement, it would be up to the agent to actually go look, investigate, and disclose to you any kind of defects about the property, anything that they may be aware of, what they've been told. They have to disclose everything to you. And that comes again with protecting your interests and putting you above anybody else. So with a customer service agreement, it doesn't necessarily have to go that way. So it's not something that I would do, but if I knew that there was an active leak in a basement, and if you had a customer service agreement with me, I don't necessarily have to tell you. You have to be fair and operate with integrity, but I'm not obligated to tell you. I personally would tell you because I don't want you buying a crappy property or getting involved with something that you're not aware of. But these are kind of the differences with that. Another major difference between this is this. There is a commitment involved with the buyer representation agreement. So with the buyer representation agreement, what your commitment is that, hey, I'm going to be working with this realtor, and the period can be anywhere between, I believe it's 2 months to 6 months and maybe even beyond. But all of those terms will be set in the agreement when you guys sign it. The other thing it also says is that the agent is going to be compensated 2.5% of the purchase price of the property. For the most part, okay? Take this with a little bit of a caution. For the most part, when you sign a buyer representation agreement, it will say that you're responsible for paying 2.5% of the purchase price. Now, for the most part, it's covered by the seller. So when a seller lists their property for sale, they are covering the buyer agent's commission within that. Now, There are certain cases where you may go buy new construction, or you might find a property that's listed for sale by owner on MLS and they're not paying that 2.5%. Now, that at that point will be a discussion that you will have with the agent to see what you can kind of work out. Whereas if you have a customer service agreement, you're not obligated to work with that agent. It could be for a specific property, a specific region, but you're not obligated to pay that agent. That agent will be negotiating on their own to be able to collect a commission. Then again, just to remind you guys, you do lose that benefit of being a client of the brokerage, and you do lose some valuable information that could be passed on to you guys as well. So you guys have to kind of decide which way you want to go. My style of kind of doing this is that I don't like to force people into a buyer representation agreement. We have to be clear as realtors to be able to present that these are the two agreements at the first available opportunity. So I do let my clients know that, hey, there is a buyer representation agreement, there is a customer service agreement, and I give them the gist of what that is, and I provide them with the documents. There's also something called like a plain language form, and that kind of breaks down some of the legal clauses that are written in there. So if you guys are interested in seeing, the plain language contract, shoot me a message or give me a call, send me a text, and I'll send those over to you if you guys want to take a look at them. But yeah, before I enter into one of these agreements with somebody, I typically like to take them out. And for myself as well, it's not just to try to lock up a client for me anyways, is that I want to make sure whoever I'm committing to working with, we're going to have a good relationship, that, we get along, and this is something that is going to be a successful transaction. So for me anyways, it goes with both parts. I don't want to lock in somebody that doesn't want to work with me. I just don't think that's fair for them, and it's definitely not going to be fair for me either. So that's kind of what I wanted to touch base with in terms of realtors. Now, I'm going to try to close this off, but I wanted to quickly go over some of the closing costs. So we've talked about roughly, basics about mortgage qualifications. We've talked about realtor. Let me backtrack for a second. Aside from these representations with the realtor will ultimately do searches for you on realtor.ca and present to you properties that may be of interest to you. The way that I would do something like this is that when I first meet a client, I'm going to basically find out what they are looking for in a property, what area they want to be in, how many bedrooms, washrooms, type of facilities that they're looking for, types of amenities they're looking for within the neighborhood. Is public transit important to them? All of these kind of factors. And then what I would start to do is I would start to present properties to them that kind of meet that requirement. A lot of times people do have to make compromises on what they're actually going to get. I think it's extremely rare to be able to get 100% of what's on your checklist. And I would say if you're getting about 70% of what's on your checklist and you have to make some compromises, I think that's basically would be reasonable. Reasonable to me anyways. You may have a different expectation of what reasonable would be. But so the realtor would come up with all these properties that you can look at. What they would also do is they would book showings for these properties, take you out to these properties. The way I would like to do the showings is that as I go through the properties, I've been through hundreds, maybe if not thousands of properties at this point. I actually like to look out and point out things, common things I can point out, and which may not even be a concern, but I want to let you know before you go through a home inspection on a property, okay? If there's something that I can tell you before a home inspector gets there that might turn you off of a property, I want to be forthcoming, I want to be knowledgeable, I want to let you know about these things up front. Common things I find out is we go into a property, I look at the date on the furnace. The furnace is 20 years old. Well, I think a statistical life expectancy, if we talk to a home inspector, might be anywhere between 18 and 22 years for a furnace. So at that point, I'm going to tell you, hey, a home inspector comes in, they're going to tell you that this appliance is basically at the end of its statistical life expectancy. And you could probably expect to spend, say, depending on the size of the house, $4,000 or $5,000 on this. These are costs that, if to the best of my ability, I want to tell you about upfront, so you know what you're getting yourself into. Another thing also is that when I show properties, I want to stand back from a house. If it's a house, I want to stand back from the house and I want to look at the condition of the roof. I have 10% idea compared to a home inspector or a professional about, how a roof is supposed to look and get a good idea of it. But I have a general understanding of it. If we see a bunch of shingles missing all over the place, they're all curled up and, they've shrunk so much and I can see water damage on it. I can point these things out to you guys and let you know that, hey, look, this might be an expense that you may have to incur when a home inspector gets here. A roof could cost you anywhere between $4,000 and $12,000 depending on the size of the roof. So things like this I want to point out, and they don't all have to be major things. Some things I go into and we see like a little bit of a leak in the ceiling. So they may have had like a toilet that had overflown or a bathtub that had overflown, and they've got some water leakage. And maybe it's not an active leak right now, but there has been some residual evidence in the ceiling. And I want to point that out to you guys, just so you know. Maybe it's a cosmetic thing. Maybe it's something that we have to look into further. When a home inspector gets there, they have something called a moisture meter. And what they can do is they can check it using a moisture meter to see if it's an active leak. Is there moisture behind that ceiling right now? So that's something I would want to do with my clients anyway. So, we'd come up with suggestions. We would book these showings. I'd walk through the property with the client and kind of, give them the pros and cons of the property the way that I see it, point out things as I see it as well. And the other thing that I would do is that if and when a client is interested in placing an offer on a property, what I would want to do is I want to come up with like what the comparable sales are in the neighborhood, just so my client is not blindly buying this property. So what I want to look at is comparable sales within the area, if possible, and recent sales. So if we had like 3 or 4 houses sell in that same area, we want to look at all of these sales, look at the features, look at the sold prices, look at lot sizes, look at different things, and then come up with a value of what we feel is for this house. Just because a house is listed on MLS at $699 doesn't mean it's worth $699. It could actually be worth $600,000. Someone's shooting for the sky, or it could actually be worth $750,000. They're actually holding back offers and they're looking to get into multiple offers. So that is something else that a realtor will do for you, is come up with a comparative market analysis for that property. There is other things that an agent would do, is like I have contacts for, obviously home inspectors, lawyers, mortgage brokers. I can provide you with contacts with handymen and stuff like that. And just kind of guide you along the right way. I usually forward documents to the lawyer that my client chooses to help facilitate the process of it better and whatnot as well. Other than that, like once we do get through an offer, negotiating an offer, I'm there for like the home inspection with the client, talking with the home inspector, maybe breaking down things a little bit better. And then we also, if that client decides to move forward with that property, we also do revisits. Usually in my contract, I write in that we're going to have 2 revisits to the property. So one time I tell them, hey, whenever you kind of really want to go, give me a heads up. You can go in and take measurements and, maybe show your family. If it wasn't during this COVID time, you can show off your property a little bit. And another time I like to go is just before closing. I want to go in just before closing to make sure the property is in good condition and all the appliances work. I want to try to test out everything as much as possible, just so the client doesn't have any surprise, the next day when they come in, or after the deal kind of closes. So. And just kind of backtrack a little bit more about conditions. Typically, I just want to let you guys know that there are 2 standard conditions that we put into offers, I would say, and that would be for a freehold purchase. So if it doesn't have like a condo element to it. The first one would be a financing condition. So a financing condition would be something for you to be able to get this offer accepted after we've negotiated it, and then be able to go to your bank or your mortgage broker and give them that agreement, okay? Mortgage, easy way I could break it down for you guys, even if you get a pre-approval, you may not necessarily be good with that property, because mortgage approval, in my opinion, works in 2 ways. So there's 2 components, I should say. The first component is you. You have to qualify for the property. So they're going to look at your financials, your debts, and say, hey, you can qualify for X. Then the second part of all of this is they got to look at the property and say, hey, do we feel comfortable lending X amount of money for this property? So that's another thing as well that the lender is going to look at. So it is 2 parts. Just because you qualify for $600,000 doesn't mean the bank is going to lend you $600,000 on a house you decide to purchase. It has to meet their criteria as well. Another condition that I always put in is a home inspection. So we want to do a home inspection on the property. A qualified home inspector, depending on the size of property, could be anywhere between $300 and $600 to come in and do an inspection. Obviously, $300 would be on a smaller end, maybe a condo or a smaller house. $600, maybe even a little bit more, would be for a bigger home for an inspector to come in. A good inspector, I think, would spend somewhere between an hour and a half and 2 hours inside of the property, going through everything in detail, and would basically explain you everything, show you everything that they have found, and then send you a report about it so you can make a decision. The way I like to kind of do these things is this. I want to make sure once we have an accepted offer that you have taken to your bank and your bank is going to approve this deal. And then I want to do a home inspection. So typically these conditions are written for 5 business days. So if we get an offer accepted on Wednesday doesn't count. So yours starts on Thursday, Friday, Monday, Tuesday, Wednesday. So that's when your 5-day conditions are over. If you're working with a good mortgage broker or a bank and you have a good contact at a bank, they could probably get you this approval in 48 hours, so 2 days. And then after that, we could go ahead and book a home inspection. But during that time, you should be talking to some home inspectors, getting a comfort level of who you want to work with and checking their availability so you're prepared to go and book this home inspection right after your approval comes in or your mortgage approval comes in. The other condition is, and it applies to condominiums only, okay? So if it is a condo property, we want to put in a condition to review the status certificate. I don't want to go into too much detail about this right now because it's going to be a forever video. But a status certificate basically is the financial health of that corporation. Ultimately, you're buying into a corporation. You want to know how the money is managed, where your condo fees are going, how they're being spent. Is this condo corporation being sued by anyone? Are they on track with their budget? Do they have any expenses that are going to be coming up that maybe the reserve fund right now doesn't have enough money to cover? You want to be aware of all of these things because you can get yourself into a lot of trouble if you don't review a status certificate. I had somebody that reached out to me recently. They ended up buying a condo in Mississauga and they had a horrible experience. I am not sure why, but this agent didn't put in a review for a status certificate, and it was the worst thing. I felt really bad talking to this person on the phone. When they initially committed to buying this condo, it was about $400. I think within a year, it went up to $600, and then right now, they've been in there, I think, like a couple of years, 3-4 years, and it's up to $800. And in my opinion, I mean, obviously anything can happen, but if you've done a proper review of a status certificate, typically these things don't happen. So you really do want to do a status certificate review and you want to use a good lawyer to do this with. So your lawyer will typically look at this for you. With the status certificate condition, the seller has 10 days to provide you with the status certificate and you would have between 2 and 3 days to review it depending on how the conditions are written. So that's kind of a lot of what the agent will help you with and guide you through. That's kind of a nutshell. I can basically do a whole different video on what the agent could do and how they should be able to help you. But again, to try to wrap this Sunday up and so we can all get on with our day, and I want to get out there and enjoy a nice drive today too. So some of the questions I've received over the time I've been kind of talking to people, and I've put feelers out to some people about some questions that they may have about something like this. One of the questions came up is obviously credit. So credit is very important when you're going to get a mortgage. So any lender is going to pull your credit report. And what you want to do with your credit is that you want to try to have it's okay to have open lines of credit. I would say to have excessive lines of credit open could look a little bit risky. But if you have a couple of credit cards, 2-3 credit cards, you have a mortgage or you have a car payment, I think all of those things are fine, okay? What you want to try to do your best with, in my opinion, is that if you have like a credit card payment, you want to try to pay this credit card off every month. Usually when they start to see 70% or more utilization on your credit card, you start to lower your credit report. I am going to do another video sometime later on. We actually had an awesome presentation with somebody from Equifax. They came in and did a great presentation. I have a lot of information about how this could affect your credit. But overall, you want to make sure that you're making your payments. Try to make multiple payments into your cards as well. So if you have a credit card and if you get paid bi-weekly, and your credit card typically ends up to being, say, $500 a month, try to pay $250 and $250 just so they can see this consistency with your payment. It will actually help you with your credit. So try not to carry a high debt on any of your lines of credit or any kind of open credit. Try not to use more than 70% of it. Try to make multiple payments into your credit as well. That's going to really help you guys out. And for me, I really like to keep things frugal as much as possible. I don't like buying things on credit. So for me, if I really don't have the cash to buy it, aside from houses, of course, I'm not going to buy it. And sometimes I do utilize credit just to play with it a little bit, just so I can boost up my credit. I use credit cards for sure. Mostly I was using them before for travel points, but I guess I'm just going to be banking those for now because no one's going anywhere for a bit. But yeah, so I don't see any problem using it, but just use it in a smart way. Again, I'll come up with a whole different video just to talk about credit because I think that's a very cool thing, especially with what's going on right now. People deferring payments right now. How is that going to impact your credit? Is it going to affect your credit? The other question I got is that from entrepreneurs, people that own businesses, like, the process for you guys to qualify for a mortgage is going to be a lot different because entrepreneurs and business owners, they actually handle their finances, from what I find, a lot differently. Not everyone is disciplined enough to take payroll. I've tried myself. I've tried to do payroll on my own, and it's hard because I have fluctuating income as well. And it's hard to say, hey, I'm going to, always take out X amount of money from my business account and pay myself. It's a difficult thing to do. But what you want to try to do is, especially when you're trying to go out for a mortgage, is you want to try to pay yourself consistently, and you want to keep a record of what you're paying. So you want to have records of these transfers coming in from your business into your personal account. Try to keep them as consistent as possible. The other thing I can tell you is that obviously, because a bank is going to look for this, okay? The other thing I can tell you is that there are mortgage brokers out there that can find products for you where they can look at. There are people out there that will want to keep a lot of their income in their business. I'm one of those guys, okay? So look, I want to try to play the tax game as much as possible, all above board. But look, if I don't need to take the money out of my business because I don't really need it to spend in my personal life, I want to leave it there because obviously I have a lower tax rate on my business. So, but that can hurt me when I want to go qualify for a mortgage. But there are lenders out there, even banks included, that will actually look at what your business income is because they understand what you're doing. So they will look at what your business income is because you're probably writing off a car. You're probably writing off some of your home expenses. You're probably writing off some of your meals and whatever else. So they will actually look at your expense that you have on your business and your income business, and they will look at you as well. And they will take a combination of these two to help you qualify on your mortgage as well. So with entrepreneurs, it is going to be different. Again, we can go on for a bit with this, but there are ways to still kind of get this thing done. The other thing is that I got a question is that, should you settle for a property right now? Considering that prices are going up, are you going to be able to find a property that completely meets your requirements right here, right now, especially if you're trying to enter into the market right now? I have always been a huge supporter of getting into the market, okay? So my suggestion would be is that you kind of get into the market, okay? If you can find something that, I know I mentioned earlier, 70% of your checklist, but if you can find something that you can be, happy with meeting 50% of your requirement, but you're getting yourself into the market, I think that's really important on the right property in the right situation, okay? So if you are able to get in and say, hey, it's only going to be a 1-bedroom condo right now and the location is not ideal for me, I would say, hey, get into that. One example I can give you is just for myself, and some people have asked me to do a video about my first property and my property moves, and I'm going to definitely put that out there for people. I've talked about it before, but I will put together a full video about it. But one of the first things is that when I was 21, I wanted to buy some real estate, and I ended up buying a unit at a building in Scarborough at Kennedy and 401, 100 Dundalk Drive, and this was a 2-bedroom, 1-washroom unit, and the price of it was $120,000 list price. I ended up paying $116,000. It wasn't that easy, guys. I got to go through so many hoops. I was 21. Nobody wants to give me a mortgage. This was in 2004. But like I said, I'll come up with another video for this. But it wasn't ideally what I wanted. Honestly, the building was a little bit ghetto. Everything inside of it was outdated. The building itself was outdated and the elevators were crammy. Every floor had its own scent. It wasn't somewhere I wanted to be in. This wasn't my dream condo or my dream home or anything else like that. But what I did understand is that prices go up, okay? Over a long period of time, prices are gonna go up. Even over, 3 or 4 years or 5 years, prices likely will go up. So if I look at that condo right now, so it's been, say, 16 years since that condo. I did sell it after about 3 years, but it's been 16 years. That $116,000 purchase, I haven't checked lately, but I think it's over $300,000 right now. So if you were to say, hey, I'm going to save up to try to get to what I want so I can have a large enough down payment, or I can get that job I want so I qualify for that property, chances are the way that our real estate market moves in the GTA, you will probably end up outpricing yourself. So my suggestion is to settle, get into your first property and continue to move forward from there to where you want to go. Like my example was, it wasn't the ideal place for me to be, but what ended up happening was, in a nutshell, I purchased that property for $116,000. I ended up selling it 3 years later for $113,000 because I was done. I didn't want to be there. And that's kind of what the market was bearing for that. But I got lucky in a way that anytime I was earning more money at work, I was actually not taking that money. What I would do is I would call the mortgage broker or the bank at the time that was holding the mortgage, and I would just get them to increase my payment. I was always on a accelerated bi-weekly payment, so it helps me pay off the mortgage faster. And then anytime I got extra money coming in, I tricked myself. I actually just called the bank. I had them increase my payment, whatever, $20, $50, $100, whatever it was. I had them increase it. Because the way I trick myself is that I know once I commit to the bank taking the money out, they're going to take that money out and I'm not going to have it. So I'm going to have to deal with whatever I have left over. So that's the way I kind of tricked myself into kind of paying it down. That's why I was okay paying, getting $3,000 less than that, including closing costs, for that condo and moving on. Because the next property I bought, I think I made like $90,000 or $100,000 on that one because I saw the opportunity to move somewhere else into a better neighborhood that would appreciate a lot more. So in that next property I bought, it went up $90,000 to $100,000. And then I just continued to use that momentum to, buy properties smartly and continue to flip them. So that's what I have to share with you guys this Sunday morning. Look, I appreciate you guys watching. I know there's a bunch of people watching it now. So I really appreciate it. If you guys have any questions about what I have spoken about, if you have questions in general, I'll be more than happy to answer them. And the other thing is that if you want to hear me talk about something more specific, something that you guys are curious about, feel free to send me a text. Number's 416-832-2000. Send me a text, give me a call, drop me a comment, like this post, please. Share it with your friends that might benefit from it as well. All right, guys, that's it for me. Hope you guys have an awesome Sunday, and we'll talk to you next week. Take care. Bye for now.
Sell it, sell it, sell it, sell it, sell it, sold. Sell it, sell it, sell it, sell it, sell it, sold. Sell it, sell it, sell it, sell it, sell it, sold. Sell it, sell it, sell it, sell it, sold.